Hey, I want to go over this triple leverage and double leverage. And, I saw this name pop up before, and I didn't really look at it. It's USLV. And somebody alerted me to this in a comment about it, which was cool. And I thank them for that. But I had to look at this because it's a new fund, right? It's a new fund. It was just launched October 17, 2011. Now, in a strong bull market, this fund is going to do great. You can see what happened over here, right? The price was $25 and it hit like 50 at one point, so it doubled in a month, right? When the silver went from the low of like 27 something to about 34, 34 something silver. So, it's got potential, but I'm going to warn you, it's the same type of deal, I think, as it tracks on a daily basis. And I'm hoping I'm not giving out bad information here, and I'm not trying to say one thing against the fund or for the fund. I'm just saying it's something for specific purposes. Now, if you know over the next few months silver was going to go, I don't know, $40 or something, you should go on this fund too. Even though it erodes a little bit and you're not going to get triple the percentage that silver moved over the next few months, you're still going to do a hell of a lot better than just holding on a spot price or even using a double leverage. I hope I'm not being very confusing about how this. I use the term erodes. They're not ripping you off. It's just how it works mathematically, and it's more volatility. The more percentage movements in silver up or down, just mathematically, you're not going to get, like for instance, over 3 months, say the percentage of silver went up 10% on the spot price. You're not going to get 20% on AGQ and 30% on this USLV. And it's not because they're ripping you off. It's because how it works mathematically. And if silver went up very, very steady, like in perfect increments, perfect, right on the nose, you would get, with no volatility, none at all, just make a nice steady curve like it was on a, like you built it or something. Then you would get twice the percentage moves over a period of time and triple the percentage moves with the USLV. But the more volatility there is, the more this fund, I use the term, erodes. And that's just how it works out mathematically. They're not ripping you off. But people, that's why they say this, it's for the sophisticated investor. Now, it could be something good for a few days. That's something. It could be. It could be something bad for a few days because you gotta know which way something's going, and I don't know anybody who knows that kind of information. Unless, I don't know, maybe somebody, well, everybody kind of thinks this. Some people in J.P. Morgan know that kind of information. But I don't even know if they know all this information. If there's only so much money in the world, and there's only so much they can take. So, if you run the numbers, if you're that damn good, you would take the whole earth inside of a year. Start running some of these numbers. So I don't even think the insiders at J.P. Morgan and Goldman Sachs know everything that's going on. And another side thing, you can just figure they cut each other's throats left and right? Just like everybody else. So I would imagine that, they don't want one to get ahead of the other too. So, and that works to the advantage of the people that aren't on the inside. That's the way I look at it. But I want to show you what I came up with real quick on a spreadsheet. Now, this is an example of a gazillion different examples you could put out. But I think this is a good way to put it, and I think I'm accurate on this. Say, for instance, silver spot price was $33.50. AGQ was $60 around that time. And I looked up USLV, which is a new fund, came out October 17th, 2011. And was around $47 at the time. And it's not important what the price is. It's important how much the percentage gain or loss you're going to have. So say, for instance, about a week later, approximately, a week later, silver goes from $33.50 to $35 spot. You got a 4.5% increase, right? Now, if you use an AGQ, you're going to get an 8.9% increase. It's not quite double, but you got to remember, over a short period of time, these funds work a lot better, and they work good in a very hard bull market. They work very horrible in a very, I mean, it's a two-edged sword plus the leverage, and the leverage is more than you think. And like I said, the erosion is something, I use this term erosion. I don't know if it's the right term to use, but that's a good way of looking at it. That's what I say. So, and I'm not saying they're dishonest. They're not dishonest. Just got to understand what it is. So AGQ in this short period of time moves up 8.91%. It didn't move up 8.96%, 8.91%. And USLV, since silver went up, it went from 30, it went up 4.5% almost. This thing went up 13.26%. Okay? So it was really cooking, right? Looks good. I mean, it didn't go up almost 13.5%, but it went up almost triple the percentage of this. It wouldn't be exactly the triple because there's this slight amount of erosion. That's what I call it. Now, I basically made this silver, I put these numbers in here. I use the same numbers over and up and down. Like, this was a pretty hard move down. You can see it's repeated, right? There's a move up. Usually after a hard move down, it might be a hard move up, a little move up, a hard. It's just an example, just because it could be a gazillion different examples. But say, for instance, you wind up back at this $35, like a half a year later, approximately 6 months later, spot price went up 4.48%. AGQ went up 5.25%. In this example, okay, I want to emphasize, in this example, because the volatility was a lot less, it wouldn't be this way. But this isn't like extremely volatile either. What happened to USLV? 2.09% in this example. So that's your danger. Now, if silver, there's a gazillion different examples. But this is a fund that it could be something good to hold long term for a few months. Well, for instance, if you knew that silver was going to go up to $60 this year, you might want to use this fund, but you would hope, if you knew, say silver was going to go up to $60, you knew this for a fact, and you didn't know what the ups and downs were, it was just going to kind of go bouncing up and down. This would be a pretty good fund to use. Say you didn't know the daily movements, but you knew silver was going to be about $60 in June. As an example, I'm not saying it is. I don't know. This fund would be good because that would be a pretty damn hard bull market, and you're not going to get triple the percentage of move of silver from, the spot price. Like say the spot price went up 90%. You're not going to get 270%. But you would still do very good. You would still do very good. But and I held this AGQ for a while before I dumped it. It was under a year, but it was more than 6 months. And I was sweating it with this thing, but it worked out really good. And this USLV, I don't know. It's scary. I can tell you that right now. It's scary. It's like the same thing as AGQ, except even even more so. Everything's got advantages and disadvantages. And I'm going to tell you right now, I don't think it's so much the technicals. You can look at this stuff and somebody can give you a class on this crap and say, this is how this works, this is how this option works. Big deal. Big deal. You know what? Calculating the mathematical formulas is not the whole game. The game is not just beating the odds either. You're not beating the odds. You're beating the majority. You're beating the majority. That's what you're doing. That's basically what you're doing. It is a gamble. That's what it is. And business is a gamble too. Everything's a gamble. And I think it's not that stupid to do this stuff, but I don't know. That's my opinion. That's my opinion. But like I said, I don't play. I'm in it to win. I'm not in here to lose. I'm in here to win. And but just watch this velocity shares. I mean, I might use this at one point in time too. I'm glad. So I forgot who that was who told me about this online here, but that's a very good. I think that's a good one to know. But also understand, it's you know, I mean, for instance, if you had a nice gain like this, yeah, it's great. Using it back when silver was at a low, this would have been the thing to do. This would have been the thing to do. Double your money in a month. Not bad, huh? And it is a lot safer than options. I know there's all kinds of derivatives and options working with these funds, and that's how they return that kind of money. But I personally don't like options too much, and that's just my preference. But options could be something better to do anyway. But really, the whole thing is it's not the mathematical calculation. It's knowing which way the markets are going to move. And I know for one fact that the guys that know which way the markets are going to move do not tell anybody, because once that information gets out too much, it's going to ruin everything. And but so I do want to make that recommendation to do things in steps. This might be I might use this fund a little bit one time, and depends. I'm going to wait. I actually had an order in for Pro Shares AGQ again. If it dropped to $60.90 late in the day, obviously it didn't, and I'm not going to touch it. It could go up tomorrow, but I don't look at that type of stuff. I only look at when I'm going to win, and that's important. Now the oils went up to $99. Fine. If it starts approaching 100 tomorrow, I don't know, it might exceed 100, but it starts getting closer. Like if it gets closer to the 100 range, I'm probably going to dump it. Could be wrong, but I think like I said, I think there's going to be a pullback on that. And this ultra leverage looks okay, but I'd be very much watching early events, what's going to happen. Like, in other words, I think I might use this if they have some big euro scare, and all the commodities take a dump, whatever you want to call it, and just a hard move down that one day. I might go into this stuff. But as soon as I see a gain, it's gone. That's the way I would play this. But like I said, it's not the mathematical calculation. Yeah, I mean, maybe you got to be smart to figure out what options are and all this stuff. It's more of a card game than anything. And usually when people are all emotional and there's a big scare going on, and this news came out about this and that and all this garbage. Now, I mean, obviously, if it's a small company and a stock in a small company, I mean, that could be another story. But I'm talking about, something major that's not going to fall apart right away. That could be a very quick trade to go into something like that. Everybody got scared to go move into something like that. Even the euro could be a good bet. And quite obviously, you look at the charts, what it was, it moved up quite a bit when everybody said it was going to fall apart. That wouldn't have been a bad bet either. But I think you can make a hell of a lot more in the metals. But they're a hell of a lot scarier because they're very volatile. And but I think right now, since the metals aren't anywhere near the high, the silver's nowhere near the high that it's been at before, I don't think it's as bad a risk. And even with this, say for instance, this is probably maybe a semi-poor example, but say, you were stupid enough to hold this 6 months, all this time, right? Well, if you're picking some price with an option, what would happen? I mean, you could lose out the whole thing. In this case, you didn't. You still retained your money. I mean, assuming in this example went from $33.50 to $35, and I don't know. I personally like the leverage, and I did use. I seen a lot of. There is a lot of funds out there on triple leverage, but run the numbers on them. You don't want to hold triple leverage and hold and hold and hold. That's a very, generally speaking, that would be a very, very stupid thing to do. Hold triple leverage a long time. It's usually a shorter trade thing. Like it's in this example, when you won a week, you had a nice gain of silver of almost 5%, 4.5%. You got in this example, you got a 13% gain on USLV. But similarly, if silver dived 4.5%, you wouldn't have a 13.2% loss. You'd be closer to about 14. Well, I think it would be about, in my head, I think it would be about 13.8% loss because the fund erodes, and that's the word I'm using. And it's not that they're cheating you. They're not cheating you. That's just how it works out mathematically. The more volatility over a period of time, you're not going to see, like if silver went up 10% in 3 months, you're not going to see AGQ go up 20% over 3 months, and you're not going to see USLV go up 30% over 3 months. It's going to go up to some number less than that, and that's assuming it went up. But if it went down, it'll go down more than that. Because, and they're not cheating you. They're not cheating you, believe me. It's just, you have to run the numbers on a spreadsheet, and you'll see what it is. It's not even complicated math or nothing like that. They're not doing anything tricky or anything like that. But just like AGQ usually is not something you don't want to hold too long. Definitely not with this USLV. I consider this a very short-term trading type thing. And I don't know. I mean, it could be some instances to use this, and I might. Thanks for that information. But just warn other people that you don't want to be sitting on this forever. Sometime it might be good. I might be telling you something wrong. If silver went to $80 an ounce this year, and you held this fund and you sold it at $80, and it took 6 months to get there, well, you're still going to be doing extremely well. But you know, beware, beware how it works.